Welcome to the webinar hosted by Catholic Investment Services. Thank you for joining us today for a discussion of the macro issues impacting the capital markets. We've had a tremendous showing here in our audience, and we're very grateful. My name is Tom Lanctot, and I'm privileged to serve as Chief Executive Officer of Catholic Investment Services. My colleague, Zayla Astarjan, has done a great job organizing this program and is at the Zoom controls. Catholic Investment Services was founded by some of the investment industry's most respected leaders to address the investment challenges faced by Catholic organizations. We are a Catholic nonprofit providing investment solutions for other Catholic nonprofits and their investment consultants, and now manage almost $1 billion of client assets in 4 different strategies. That number was a lot higher before the market adjustment. Enormous thanks to our own 3 wise men, who you will meet shortly. Today's format will be conversational. There will be time for audience questions during and after the formal part of the program, so please use the Q&A feature on your Zoom screen to submit a question. Our audience is muted. The program is being recorded and will be available for replay on our CIS Institute webpage and in podcast format. You received biographical information for our panelists, but I want to emphasize a few highlights. Jack Brennan is familiar to many of you through his many noteworthy leadership roles, including as a founder of CIS and the founding chair of our board. You may not know that about 19 years ago, Jack wrote an almost best-selling book called Straight Talk on Investing, which he recently updated and is now available on Amazon. As with the original version, Jack is donating all sales proceeds to a nonprofit supporting early childhood education. Like Jack, Ted Disabato has a highly accomplished investment industry track record and has packed a lot in during his 35-year career. Pairing a degree in chemical engineering with a Wharton MBA, Ted uses his STEM brain as a powerful and effective advocate and trusted advisor to his clients. Like many of you, he also serves as a Catholic investment fiduciary. We at CIS appreciate the constructive and thoughtful way that Ted serves our common clients. As part of his duties at TIFF Investment Management, Jay Willoughby leads the team that manages the CIS Catholic Endowment Fund and its 2 components, the Catholic Diversifying Strategies Fund and the Catholic Global Equity Fund. Jay is a great friend and partner to CIS and an accomplished and thoughtful long-term investor who is always honest, transparent, and incredibly tolerant of my consistently dumb questions. Jack and Ted and Jay, thank you for contributing your time, talent, and experience today. Your many years of service and experienced perspectives will be especially valuable for our audience. But before we begin our program, please join me in a short prayer. Dear God, please grant us the serenity to accept the things we cannot change, the courage to change the things we can, and the wisdom to know the difference. As always, we pray for peace and offer prayers and thanks for the women and men, religious and lay people who, through their work for Catholic ministries, have devoted their lives to something bigger than themselves. Amen.
Amen.
Jack, take it away.
Thanks very much. And thank you and Zayla for organizing this and frankly inviting me to join these 2 as part of this this webcast for our audience. We're thrilled that you're with us today, and we will try to be very inclusive and in our time together of many of the issues that are confronting fiduciaries at Catholic enterprises around the country. And I'm particularly pleased to have Ted and Jay as our prime guests. They're 2 of the clearest thinkers I know in this space. They're 2 of the best communicators I know in this space. And not unimportantly, they're also great friends of CIS. So our program, as Tom said, is going to be conversational. We will be discussing a bunch of different things that we think will be of interest to our audience. We've seen who you are, and in many cases, the role you serve, whether it's your profession or you're a board member or you're a consultant to Catholic enterprises, the variety of skills and experience that you have are important. And we will try to be as inclusive in providing insights over the next hour as we can possibly be. As you know, obviously, it's been a very interesting time more interesting than most. We had a couple of these back in 2020 when it looked like the world might be coming to an end in the financial markets because of the pandemic. But right now, we sit at a time where, over a 1-year period, the markets have been not very good to investors broadly. Those are liquid and private markets, both debt and equities. Some of our fixed income assets are at interim period highs after a long bull market and then 0 or 1% interest rates for a long time on the short end. So there's much going on. And one of the things we know is going on that is you all serve in your roles. You like to hear what others are thinking, what challenges other institutions like your own are facing. So I'm going to start out by asking both Ted and Jay, who have a window on the world that most of us don't have because they serve many institutions like yours, like ones I serve as well. And they have a chance to listen to concerns that are on people's minds and how they're thinking about solutions to those challenges. I'm going to start out there, then we'll work our way down through issues like inflation, where we had several questions come in ahead of time. Obviously, rates, asset mix, diversification, and other themes that matter. But with that as background, Ted, could I ask you, you spend your life counseling nonprofits, and tell me what you're hearing in terms of big themes where people are concerned about, whether it's real returns, whether it's diversification, and so on. Share with the audience what you've been hearing over the last 6 months and a year as we've gone through this challenging period of time in the markets.
Sure, I think that's a great place to start. As you know, Jack, Meketa is a institutional investment consulting firm. Our assets have actually grown to about 1.8 trillion in value. And of course, as a result of that, many of our clients have large staffs, investment staffs and boards that they're responsible for. And there's two key issues that these committees and boards and staff are dealing with. The first one is really the ineffectiveness of diversification. And that's largely driven by what's happened in the US bond market. Core bonds have, I saw a report from Goldman Sachs that said it was the worst bond market since the 1890s. I guess they've been around since then, so they might know. Usually government bonds don't decline like they've had, but when you look at risk mitigating strategies that have historically relied on fixed income, and especially for the storehouse of future spending that might occur within the fiscal year, that's been a challenge. And the second thing is really doing to try to make a sense of whether the declines we've seen thus far are an ordinary decline of which you live through, and we've done so in 2008, 2015, 2018, 2020, 2022, and you live through these.
I'm sorry, that's making me understand why our hair is gray. What hair we have left is gray here. It's been a tough run here, Ted.
Yeah. And Jack and Jay, you'd think you'd get used to these. So after nearly 40 years of doing it, you'd think but you still stay up at night worried over these things. And so there's part of it, you're trying to understand the trajectory. And in the viewers of this webcast, one of their key issues is there something I need to do? So we have two objectives for our conversation today. One is to lay a framework for understanding what's going on globally. And then secondly, is to give them some concrete view on what should be done about that. And so throughout this presentation, we'll do that. So in a summary here, the first thing is really, what do I do about diversification and mitigating risk? And secondly is, where do we go from here? And we hope to answer those questions.
That's a great summary, Ted. Jay, you're in calls and conferences with your investors all the time. Pick up on where Ted was and talk a bit about what you're hearing as you engage.
Sure. Great to be with both you guys and Tom and Zayla. Always a pleasure. So I think Ted did a pretty good job. I'll try to summarize that and say it's a really confusing period. About, I don't know, Jack, 6 months ago, or maybe a little longer, maybe it's between 6 and 12 months ago, you called me and you said, Jay, you're the only guy I know who's old enough that he can remember inflation. Let's do an inflation call. And at the time, I believed what the Fed was saying, that this is going to be transitory. We changed our mind when Russia went into Ukraine, but we were wrong. And the Fed was wrong. And the Fed has gone from quote unquote transitory to this is going to be a long fight. And so I think that makes it a really difficult environment for everybody to really fully understand. And if one looks back, you know, some of the people, the managers, I would say the smarter investors we talk to, they look back and they say, you know, the last time we had a situation where we had benign inflation for a long time, and then inflation hit and people didn't really think it was a problem. It stemmed from, you know, a little bit of this guns and butter thing that's going on in the world today, and higher energy prices that resulted from, you know, at around the same time, and new sort of experiments, let's call them, in monetary policy was the 1970s. And so, you know, we didn't fight it as aggressively as we might have in the early going, and rates stayed below inflation for, you know, a few years. Interest rates did. And then ultimately, you know, it was all hands on deck, and Volcker had to really raise rates a lot. So that's one thing that could happen. Of course, the other thing that could happen is there are economists who say inflation is always and ever a monetary phenomenon, and money growth has gone from almost 27% year over year to now it's down to 5.3% because all of the big stimulus programs during COVID and so on sort of tapered down. So I think it's a really confusing time. And I think people are people, we all are. The experience that Jack, you and Ted, and hopefully I have of living in the markets for, you know, 40 years or so, is that we've seen a lot of these things, and we know that you want to try to anticipate and, you know, what might happen next and not react to what just did happen. But, you know, people who don't get the chance to spend 40 years doing this, that's a harder thing to do. You know, you're feeling the pain because of what's going on in the markets. And so I would say that, you know, just across the board, the things that I hear most commonly from clients of ours and prospects are, we don't like growth. Growth is terrible. Everything was way too expensive. And, you know, PEs came in approximately 50%. Like you, Ted, I was reading a research report the other day, it said PEs declined 50% on companies that are posting 20% or greater growth. Well, that's a pretty big whack. I would say on the private side that you know, we want to stick with private equity. We don't want to be in this venture capital stuff. That stuff, you know, went up a lot and it hasn't come down necessarily as much as it's going to. You know, what I try to do, what we try to do is keep balance in the portfolio as best as we can at all times. You maybe don't go up as much as the people who are just in the growth or the venture, whatever, along the way, and then you don't go down like that either. So balance, I think, is the one thing that we try to talk about in terms, and then I'll shut up here, but in terms of, you know, bonds, like Ted said, this has been a horrible period, and the 60-40 portfolio, which you'd asked about the last time, Jack, was the worst year in 90 years. So you got to go back to 1932. The first 6 months of 22 were the worst since 1932. That's always been something that kind of hung in there pretty good, no matter what the world brought its way, and it didn't this time. So we're starting from a point where a lot of things were pretty highly valued, and and the correlations went from negative, yin to the yang, versus positive because inflation is job one, and full employment and everything else kind of goes out the window when you do have inflation, because you gotta whip it. You gotta beat inflation as fast as you can. So those would be probably the best I can do.
So let me pick up on the combination of those two things, and let's talk about diversification. It balance is part of it, obviously. One of the great strengths of institutional portfolios has been diversification, which has smoothed the ride from point to point, various things. So Ted, I'm a client, and I say, convince me it works. Convince me it works. Jay just told you 60-40 was the worst 6 months since 1930 something. How do you respond to that? And maybe it's combined with, this is a short-term phenomenon, or from discrete lows on yields, almost invariably you had to lose money on bonds at some point. But how do you respond, Ted, to that one, to that question about the value of diversification?
Yeah, sure. There's that's a many-faceted question, but there's some straightforward answers to it. First off, declines and discounts make things start looking attractive. So for the first time in maybe a decade, the bond market is beginning to provide reasonable yields for faith-based investors to store some of their expected spending in that area. So if you can get 2 or 3%, if a client were to say, I've got this spending need, a capital need or something, there's attractiveness to the short end of the US Treasury curve that you can invest in now, or 2 or 3 year treasuries that make a very attractive short-term diversification against this variability. And this too will pass. The declines set up an opportunity for future rates of return. So there is a solution here. So even if you've seen some of that bond market decline, the short end of the yield curve probably is close to as high a yield as it's going to get to. And if you can get 3.5% on securities that are your spending securities over the course of the next 1 or 2 years, that's something you want to clearly look at and take advantage of. The second thing is there are now opportunities and other risk mitigating strategies that aren't necessarily fixed income oriented, that respond to the current environment, and those are opportunities as well. Here's the heart of the matter that we'll get to a little bit later in here. One of the most surprising things has been the strength of the US dollar. It's anti-inflationary. You don't expect in an inflationary environment your currency to reach a 30-year high, which is what the US dollar has done. So we're at significant cycle discounts internationally, cycle highs in the US dollar. The next thing you want to do is have faith that a broad global diversification of equities is now, for the first time in 10 years, going to make sense. And I know it challenges a lot. You can say, if we do a tour around the globe, whether it's in Asia or Europe, you can highlight those problems. I will warrant to you that the discounts justify those investments. So let me summarize this. For your spending needs, the short end of the US Treasury curve, avoiding credit at this point is the right thing to do for your spending. The second thing is have faith that global diversification, even in the face of questions about globalization, due to the peak value of the dollar and the discount in international investing, those are the two key pillars that you ought to make sure you have the proper diversification in those areas in your portfolio.
Great summary. It is, there's always an inherent contrarianism in the best thinking. I say that like it's gospel. It's not gospel, but leaning against the current trends, that is something that is really important and hard to do.
Yeah,
Right.
and I will see, you'll hear us, maybe Jack and I more than Jay and I debate this question of inflation. You know, if you look at the futures curves, the market is clearly identifying inflation is going to moderate. And that's probably the camp that Meketa's in. I'll say this, and maybe this is comforting to our viewers on this webinar. Had you 2020 foresight that we would get up to 8 or 9% inflation and tried to hedge against that by investing in TIPS, which are down, let's call it 9% as of June, gold down 13% so far this year, that was difficult to hedge away any of that inflation risk. And we'll debate later on what the right approach is for inflation. But I bet, Jack, and I'll say this again, as I did before, that it's likely that inflation will surprise on the downside by 2023, that we'll see if that turns out to be right or not. I think the futures market, which is expecting something like 2 to 3% inflation by 24, that may not get there. But we're clearly not going to stay at 8% for long.
I don't disagree with that. I'll take the over on the on our bet, but we'll let Jay moderate it. Jay, talk about diversification as a secular matter, because I think it is important for us to step out of it. And I'm interested in risk assets. Think about equities and other things. How do you think about diversification and ensuring that we don't look at the numbers I have on my piece of paper here, which are ugly, and we think longer term with the objective, and we'll come back to inflation more specifically, but real returns is what every one of your investors needs, right? Nominal returns mean nothing in some ways. It's all about how do you, so talk me through that as an investment premise and a philosophical premise.
So I guess I sort of think of savings as deferred spending. So if you're going to defer spending today, you don't want to not buy a loaf of bread because in the future you'll be able to buy half a loaf of bread. You want to be able to buy 2 loaves of bread, right? You want to get some reward for actually saving. And it's I hope Ted's right. I'm not 100% sure which way it's going to break. I think it could break either way. If you look at what's going on with wages, the Atlanta Fed wage tracker has wages at 6.7%. It's the highest since they started tracking them, which goes back into the late 90s. I was reading this morning, there's a big rail union contract that's got a week to go, and they might go out on strike, and if they can't come to an agreement. So I don't know. I just think there are a number of these on the wage side, a number of these kinds of things that are concerning. And so if inflation does come down right now, you can buy a 10-year TIP, Treasury Inflation Protected U.S. Treasury bond, and you can make almost 1% real. So it'll pay you whatever inflation is plus 1%. They could get maybe into the 3s if things got really bad. That same, on the shorter end, like you were talking about, Ted, I totally agree with you. We owned some TIPS and sold them because the yields were negative 2.5%. And now those same yields are positive, depending on what you think inflation is going to be, but somewhere in the 1.5% or so range. So that's been a 400 basis point compression. The 30-year bond, if you bought a nominal 30-year treasury, the on the run on December 31st, it's down 30 points. It's down 30% this year, price change. Those are death and destruction, boy. That makes it really hard to be super bearish about things. 1% real, at least it's a real rate. So you can buy, 1.1 loaves of bread or whatever. So I guess when we're trying to look at asset allocation, we've always hedged our currencies. We have a global equity portfolio, and we've never owned. So let's say we have, 5% overweights in some country. That means we're 5% overweight their currency. And we've always said we will never be more than 3% overweight anybody's currency other than the US dollar. Right now, to Ted's point, I think if the US dollar gets a whole lot stronger, it's going to strangle the whole world. It's raising everybody's costs and really hampering economic growth globally. So we're not doing anything about that. We're glad we've been hedged, but I do have a number of people saying, Jay, this is the time to take your hedges off. So I don't know. I think it's a really hard time, Jack, to know what to do. And so therefore, what I think you need to do is you need to go sort of back to basics, or make sure you stick with basics. Not a good time to try to be a hero. I don't know. I thought it was sort of funny maybe in a strange way. I talked to two people this morning, and one of them said that with this escalation, this success that Ukraine is having against Russia, just, in the last few days, that Russia's now going to seek to negotiate a peace, and then that way they're going to be able to sell oil and natural gas to Europe, and prices are going to come way down, and Europe's going to be great, and the whole world is better. And another person said they're going to escalate, and they're going to do a scorched earth policy, and India and China won't be able to buy oil from them anymore, as they have been through the back door. And so now that really goes off the world's supply and demand stage, and prices are going to go way up. And I just think, they're both intelligent experts in their field, but that's just how hard things are today. So bottom line is, in our opinion, it's the right time to sort of stay at a long-term strategic asset allocation that has a proven ability to work over an extended period of time, and don't try to become a hero just yet. Those opportunities will come. They always do. We'll talk about it more later, but we just don't think they're here yet.
Let me just ask either of you, is the dollar a flight to quality? Is the dollar strength a flight? What are your views on why it happens? It obviously makes international returns look even worse than they might be in local currency, right? And so selling the idea of global diversification in equities, at least, is harder in some ways, because the trailing returns look, and again, a contrarian would say I'll go the other way. But what do you think it is? Because it's one of those things, people don't naturally get the dollar thing, because we have such a broad economy. You don't really need to worry that much about it. What do both of you, be interested in just a quick thought on why the dollar is so strong?
Well, I'll take the first shot at that. I'd like to start out that answer by saying investing is all about, is it getting better or worse? Not about, is it good or bad? And that's really hard for stewards of capital to think about, because the day that you're looking is, you're always assessing whether things are good or bad, not whether they're getting better or worse. And so I want to say that again, it's all about things getting better or worse. So let me ask you this. Do you think the inflation is getting worse or better? I'll say it's getting better. We can debate how quick it is going to get better. The market's clearly, in terms of break-even yields, decline in gold, and decline in broadly in commodities, all the other inflation hedges, the market would be saying inflation is getting better. The Federal Reserve, and I think you can believe them, is saying we're going to whip this thing if I'm responsible for employment and stable prices. I've done my job on employment. You can get a job. In fact, maybe there's too many jobs. So maybe I'll give up a little bit on that. And I think you can believe the chairman when he says we're going to fix inflation. So I think that issue is getting better. The dollar, can it get stronger? everybody's long the dollar. Everybody was short, 18 months ago, and now everybody's long the dollar. Can it get better? I think it can. It's not as clear as inflation as to whether it's going to get. There are two reasons why the dollar is as strong as it is. One is because our yields are better than nearly every other country. Even with a lot of foreign buyers backing away from dollar-denominated securities, it seems like we can finance our debt, and so there's really no much of a question about that. So it's, as you indicated, Jack, both a flight to quality and a relative value play. And but there is a question of this monetary issue of too many dollars and too few buyers. And if I had to press on that, I'd say the dollar's heading to be worse rather than better. And that those are the two issues. So both on inflation, and by the way, inflation and currency is the same thing. We could spend some time debating that. That's why I answered the question about the dollar. In inflationary terms, the strength of your dollar versus the rest of the world is just a counter position to what you think is going to occur with inflation. For those that are very negative about inflation, it would be hard for you to think our currency would get stronger in that environment. Then I'll answer one more question that you didn't ask, and that was about diversification. And I'll just say this, that viewers of this webinar should think about private versus public market diversification. There's some real issue there of trade-off on liquidity, and we'll address that.
Hold that one. That's
later on.
That's
yes.
That's an important part of to keep them around for the second half of the call. You always got to give them something to look forward to.
Yeah.
Jay, how do you think about it? How do you think about it?
Cleanest dirty shirt. Do you want to own euros? It's a possibility. If you could talk to certain people who tell you the euro is maybe going to come apart if Italy decides they want to pull out, if the energy situation leads to people freezing this winter, then countries are going to go their own way on all of this, etc. Do you want to own the Japanese yen, where their deficit is 3 times GDP versus ours is just 1 times GDP? So, I think it's that. And then the only other thing I'd add is, if you're going to be the reserve currency, the currency that everybody uses to, conduct trade, et cetera, then there have to be enough dollars in the world. And that means we have to run a big trade deficit. And we're doing kind of the reverse of a lot of those things. The Fed is selling bonds. QT has begun. Our trade deficits actually come down. I just punched it up while Ted was talking. It peaked at about 107 billion in March. In July, it was only 70 billion. So, the trade deficits come down, at least for a few months here, as as a result, there are fewer dollars floating around in the world because we didn't overspend by quite so much. So some of these things, but I do think that as a rule, currencies are, they go up and down. And so I would tend, as you suggested, Jack, to think of this more as an opportunity than as a fear, with it already as high as it is.
I want to ask you a specific question about the portfolios you run. Fixed income has had a different role for you than it might have had 20 years ago or 30 years ago in the TIFF portfolios that you run. Just very specifically, how are you using treasuries today? And is it a capital preservation? Is it pure diversifier? How do you think about it? It might be helpful for people because they get advice from lots of people on this subject.
Yeah, so I think there's 3 ways to look at them. One is, if your duration is pretty short, you don't have a lot of very long dated maturities, then the price can't change a lot, right? You make 3% in a year, and if rates were to jump up, you get your money back at the end of the year. So you don't suffer capital losses. So preservation of capital, it is a diversifier. It hasn't been this year, as we talked about, but under most circumstances, treasuries are a diversifier. And then the third, and one of the really important things is as a liquid source of capital that can be deployed elsewhere when opportunities present themselves. So, if we saw whatever that we thought was a real opportunity, maybe typically for us, it's to invest in stock somewhere. We can sell treasuries. This is what happened back in March, Jack, during COVID of 20. Stocks got killed and treasuries went up. That's the thing you want to sell when you want to redeploy into an asset that's gone down. So Ted's exactly right when he says avoid credit. High yield and even credit, decent credit, investment grade credit bonds were down low 20s, 22, 23%, and stocks were down 33%. So you want to sell something down 23 to buy something down 33? That's good. But if you can sell something that's up 3 or 4 or 5% to buy something that's down 33%, that's even better. So liquidity is really important in addition to the diversification and the capital preservation that treasuries, and pretty much treasuries alone, can provide. Some of the other great quality stuff maybe, but we try to stay in the really liquid stuff on the treasury side.
Helpful. I'm going to flip to a couple of questions from the audience. There are thematic ones, but Ted, I'm going to ask you this one. It's gets right down to what I'm sure is on a lot of people's minds, and I'll modify it just a bit. It says, for budgeting purposes, nonprofits that rely partly on drawdowns from endowments to help fund operating costs face the challenge of making realistic guesses about percentage changes in the market over the next several quarters. I'm not going to editorialize because it's a challenge here. I bet it's a question you get frequently, and they say, "What's your counsel?" And I might extend the question out a little bit. Say, if they're thinking about a 3-year budget, just to make it a little longer term. So how do you react to a question like that, Ted? What counsel might you provide to somebody?
Sure. I'll go to the survey on this one. Surveys at the beginning of the year continued to establish that we're in this low return environment, low yield, low return environment. Now, some of that has been significantly fixed. So now you can get reasonable yields on fixed income. I stumble over that word reasonable. You can get a yield, let's call it that, on fixed income, quality fixed income. And stocks with the discount that we're seeing, whether it's internationally in the emerging markets or the US or globally in general, you're going to see those surveys increase the rate of return expectations for the next 10 years or even the next 3 years starting in 2023. So in the next 3 months, all firms, including Meketa, will be publishing what we expect to happen in the short run. And I suspect that from the beginning of this year, you'll see 100 basis point improvement in expected returns. So if someone were to say, what should we be planning? Now, most thoughtful endowments have kind of a rolling spending evaluation that takes out the short-term variability, but things are going to start looking better in 23. I think this, I don't think we're over with this risk-off period. I think it's going to extend through the end of the year. But that's going to set up a better 23, both in terms of yield and capital gains. And so if you were assuming something like a 5 or 6% return, I think we're going to be back up toward that magic 7% in 2023.
Very helpful. I, of course, immediately go to real returns on that one. And my real return expectations are lower than yours, but they're not as wide as they might seem. Let me turn, Jay. Let me ask you a question. Again, one of the other things we're going to see is big endowment returns are going to be posted pretty soon when they get their private marks. and they're not going to look like 50s and 60s and high 40s that we saw last year. That made headlines all over the place. Two-part question, Jay. What if last year, I'll make up a number, it was 45% on the major endowments. Some of them are much higher than that. What do you expect to see posted in the coming year based on marks, mostly in the private side, but obviously the public's? Take that one first, and then I'll follow up with a separate follow-on question.
So I'll try to hit that one a little bit and then hand it to Ted, because I think Ted has probably a better sense of what, a broad swath are going to come in at. But I do think on the private side that the closer that you were, the more fully invested you were in things that were, call it pre-IPO, the more equity market like those returns are going to be. I would tell you that through the first 6 months of this year, I've been really surprised at how little the private marks have come down. And so most of them are talking about sort of down 5 or 10%. And that seems really gentle in a world where, the markets were down around 20 at the end of June. So we did have one manager that said the further you are away from the IPO window, the less change you'll see in those marks. And I said, what do you mean by that? And he said, well, I mean that if, Ted and Jack and Jay came up with a venture capital idea and it was going to get a C and people thought it was a good idea, the value of the dream did not change. But if that company was 10 years old and it was producing, 100 something revenues and trying to come public, then that's going to get marked down, substantially. So I don't know, Ted, are you seeing guesstimates for, total returns for the 12 months ended?
Well, that's a good point. We've had a lot of conversation with general partners and about what's going on with their marks. And they're basically responding like in the public markets that the fundamentals of these companies haven't changed very much. So therefore the valuations haven't. I would suggest to our listeners that the thing they really want to do is scrutinize those investments that need a lot of follow-up financing. That might be the area that's difficult. And I don't suggest that marks are going to change very much because most of it's been PE compression. There's going to be some adjustment, but as Jay indicated, it's not a liquidity-driven decline. It's really this, what is the proper multiple for paying for a private company, and there's going to be some debate about that. Marks are going to come down, but they're certainly not going to compress the way we've seen them in the public markets. May I say one more thing about that? My friend Bob Farrell at Merrill's famous technician, he has 10 famous rules. Everybody should print them out and post them on their wall and recite them in the morning. One of his more famous ones is, if everybody thinks something's going to happen, something else is going to happen. I paraphrase that. There isn't a firm out there that isn't expecting higher returns on private market investments. You need to be a little skeptical about that. And these discounts in the public markets may give them a run for their money.
So listen, that was going to be my second question for you guys. Is just let's talk a little bit about, I have a personal framework for equity investing, which is that it's all just equities. It may be indexed. It may be high cost indexed, which you never want to have, which is, bad active. It may be sharply concentrated active in the public markets. And then it's privates. They're all the same. You're looking for a stream of cash flows in the future. And diversification among those three types of strategies is some ways very prudent. You save a lot of money on the indexed, and you have some liquidity in the highly concentrated equities, and you pay a price. You've got expensive and illiquid. So Ted and Jay, I'm going to come back to you after this on the same topic. talk about that as a framework and how you think about it as if you're a fiduciary overseeing an important portfolio. Should most institutions who can afford to take some illiquidity risk have a private slice in that portfolio to take advantage? If that description makes some sense among the three ways of getting equity exposure, how do you think about that?
Sure, and I think there's two basic reasons why private equity does a little bit better. When you make that investment, you get a little dose of leverage along with it. These companies usually have levered balance sheets, and that equity performs. That's a good thing. There's probably relatively stable financing behind them. So, and a sponsor that will help them out and prod them toward progress. And then the third item is that usually the private equity managers have a little bit of a better personal stake. So you combine leverage with a board and an active general partner investor that can prod that management team into better performance, and you have a financial incentive by that management team. Lo and behold, capitalism works, and those companies do well. I think that's the recipe, and that recipe hasn't changed. And you know, that would be something. But you want to make sure that you're careful about that. I'll recite to you one comment I heard from a very large general partner who has had you know, decades of success. He said, you know, we're always hearing about this ability for private markets to outperform, and I've been hearing that for 30 years, and it's still the case. It's going to be true for the next 30 years. Well, I'm not as sanguine about that as he is, but I'll grant you the three factors that I laid out haven't changed, and private markets are worth considering, not only in that area, but of course, private market, real estate, infrastructure. Those opportunities are real in an inflationary environment.
Who your partner is matters a lot. That thing.
It sure does.
The academic data shows that on average, private equities have not outperformed, particularly after fees, have not outperformed public markets.
You're absolutely right.
Even adjusting for the leverage, it's interesting data. Jay, your firm has both privates and publics. Can tell us, give us your point of view on, again, sort of optimizing your exposure to the equity markets, which in the end have always been the best in real return producer. Maybe it won't be true in the future. I can't imagine it won't be, but tell us how you think about it.
Well, so for 38 years, I've been a public equity market guy. That's where I started. That's been my love. And about 65%, our target is about 65% in equities. And so I might surprise you a little bit, Jack, when I say begrudgingly, I have come around to believe that when you can buy when you want, you don't have, if you allocate $100 to me in the public markets, it goes in the market today. And I might say, well, I don't really like the market today, but that doesn't matter. It goes in the markets today. If I'm a private guy, I can wait until I find what I think is a real, sweetheart of a deal. I make the investment at the price that I want. Then I get to go in and change the management team or upgrade it, try to make it better, improve the sales, improve the supply chain, improve the entire cost structure of the company, and then ultimately manage the capital structure, as was alluded to optimize the returns. And then I sell it when I want to. Those are some pretty big advantages. When you're a public company, you report quarterly, and the analysts, they all write down what you say, and then the next quarter you can't change your strategy or you're kind of stuck a lot more. So I really do think privates have a structural advantage that should enable them over the long run, maybe not in the next year or whatever, but to continue to outperform. I would say on the public side, we think that there are managers who can add alpha. So we prefer active, but you can't always find them, or you can't always necessarily partner with them. Sometimes they're full, they won't take new money, etc. So we do use passive. To your point, if you can't find somebody you have a high degree of conviction in, don't pay a big fee or a bigger fee for something you don't think you're going to get. And so we do use passive in almost all of our portfolios as well to round out the exposures. And we even use one that often that you might be familiar with from your previous
which
work.
we have a tendency to call index, not passive.
Okay,
Passive feels pejorative. I'm kidding you, but
okay.
it's one of those things that I've spent 40 years trying to convince people there's more to it than just getting up in the morning for a minute, then go play golf.
Right. So I'm now duly noted.
I'm gonna send you a bill for $1 every time I hear you call it passive. So it'll buy. Hopefully, it won't buy me anything down the road.
I see that Tom and Zella have reappeared, so we're in our closing moments here. So I want to leave an analogy here that will be painful for Jack to hear. But for the next 12 months, because you've asked that, we want a structure here for the viewers to steward their assets. They should have a structure like the Tampa Bay Buccaneers. Strong defense with a potential for a powerful offense that will soon raise itself given the opportunity. I make no reference to Tom Brady in that for those Boston people, but nonetheless, you should put defense in front, and there'll be an opportunity for a strong offense here soon with these discounts, but wait for 6 months before that happens.
Very helpful, Ted. Thank you. Jay, your point of view in the nearest term window?
You know, Scott and I did a CIS quarterly investor update here a few weeks ago, and I tried to do something like Ted, and then I said, Scott, what do you think? And Scott said, it's too hard to call the short term. We never tried to call it at Notre Dame. And I thought, boy, that's the right way to go there. So I'm going to try to split the baby. If you really pushed me, I'm kind of more in Ted's camp. But the short term is so hard to call that I think you just kind of want to stay as close to whatever your basic natural position is. For us, most people on this call may know is 65% in global equities, it's 20% in hedge funds, and it's 15% in short duration fixed income. We think that's how you can protect capital and then also participate when the turn comes, and we might get a little more aggressive when that happens.
Okay, I'm going to close with 2 quick questions and single word answers.
Hey, before you do, Jack, what do you think? I mean, I bet you people on this call would love to hear.
It's funny. I have never been able to think in the short run, actually. I really don't. And so I'm not the best investment committee member if somebody wants to be talking, because I think you have to do it. Ted mentioned rolling 3-year, rolling 5-year budgets and looks, Jay. It's not a cop-out. It's just, I just somehow genetically don't have the ability to care much about 6 months. I'm also frighteningly fiscally conservative. So generally, wherever I've been in charge of something, big swings don't matter much in the short run, and it's about the real returns. Okay, single questions. Two, and first question, you each have to answer: real return on a 3-year or not over the next 3 years. Will I earn a real return on that bond?
Not in 12 months, but in
3 years.
36. Yeah, 36 months. You'll go back to real returns. Yeah, we'll have positive real returns on bonds. What that means is that we're going to stay at 3% yields, and inflation is going to go below 3%.
Okay.
You will have lost too much in the first year to make it up in the subsequent years. So no, you will not make positive real returns.
Okay, then more important than that, I just reserved hotel rooms in Ireland for next August, just 11 months from now. And the question is, do I prepay or not? And
Prepay.
Ireland is still in the euro. So do I prepay or do I wait to pay on because my life is dollars? You say,
Prepay.
Ted?
And prepay for both your kids too. They deserve it.
These are for my kids. These are
Yeah.
for my kids. Okay. So that tells us at least which way the dollar's going against the euro. Good. I'm sure that's very important to everybody watching this, but I figured I might as well get some cheap advice from two really smart guys. Thank you both so much. I've learned a ton. I hope our members, our viewers have, our investors. We tried to get it thematically at your questions. Thank you all for that. Zayla and Tom, back to you.
All right. Well, let me add my thanks to our great panel and my apologies. We knew going into this that we were going to run out of time. And so we have a lot of great questions that we haven't been able to get into the panel, but we will do our best to see if we can get answers to the individuals who have submitted these. And Zayla will track these and we'll do our best. And we'll also get Mr. Farrell's 10 commandments out to everybody so that they can follow Ted's advice. But again, let me on behalf of all of us at Catholic Investment Services, let me thank our panel, but most importantly, let me thank our audience today for joining us. And again, I apologize if we didn't get your question answered, but we'll do our best to track that. And with that, we are adjourned. Thank you.
Thanks.
Great seeing you all again.
A lot of fun.